What is commercial banking? Definitions and scope. On a quiet Monday morning, Daniel, the owner of a small but growing wholesale business, walks into his local bank. He is not there to deposit money or withdraw cash. Instead, he is meeting a relationship manager to discuss expanding his credit line. His business has grown steadily, but Go now demands working capital, better payment systems, and financial advice. What Daniel may not fully realize is that he is stepping into the core world of commercial banking, a system designed to support businesses like his at every stage of their journey. Commercial banking, at its simplest, refers to the range of financial services that banks provide to businesses, governments, and institutions. Unlike retail banking, which focuses on individuals, commercial banking is centered on supporting economic activity at scale. It includes accepting deposits, providing loans, facilitating payments, managing cash flows, and offering advisory service. But this definition, while accurate, barely scratches the surface. In practice, commercial banking is less about isolated services and more about financial ecosystem. A commercial bank acts as a bridge between those who have excess funds and those who need capital to grow. It transforms deposits into loans, risk into opportunity, and transactions into structured financial flows. This transformation is not random, it is guided by strict regulatory frameworks, risk assessment models, and sophisticated financial analysis. Consider Daniel again. When he deposits his daily sales into his business account, the bank does not simply store his money. Instead, those funds become part of a larger pool of capital that can be lent to other businesses. Perhaps a construction company building infrastructure or a startup investing in new technology. This process, known as financial intermediation, is one of the defining features of commercial banking. What makes commercial banking powerful is not just the existence of these functions, but how integrated they are. A single business relationship often involves multiple services working together: accounts, payments, credit, and advisory, creating a seamless financial experience. Modern commercial banking has also expanded far beyond traditional branches. Today, digital platforms allow businesses to manage payments, monitor liquidity, and access financing from anywhere in the world. This digital shift has significantly increased efficiency while also introducing new challenges, particularly in cybersecurity and data management. From a scientific and economic perspective, commercial banks are central to what economists call the money creation process. Through lending activity, banks effectively increase the money supply within an economy. Research in financial economics shows that this process is closely linked to economic growth, investment levels, and employment rates. In other words, banks do not merely respond to economic activity, they actively shape it. Yet, with this power comes responsibility. Poor lending decisions, weak risk controls, or excessive speculation can lead to financial instability. History has repeatedly demonstrated that the health of commercial banks is directly tied to the health of the broader economy. This is why regulatory oversight and internal risk management systems are so critical in the banking sector. For someone entering the field or seeking to understand it deeply, the key insight is this: commercial banking is not just about money, it is about trust, structure, and informed decision making. Every transaction, every loan, and every financial product is built on the foundation of confidence between the bank and its clients.